Just got a few simple tips and tricks about property investment, just to help you with your investing and to help you maximise your tax benefits. So the first one we're looking at is personal debt versus business debt. When I'm talking about business debt, I'm looking at business or rental debt. It's sort of an interchangeable word. So the first part is if you've got interest on a rental or business, that debt's going to be tax deductible. So if you're paying, say, 6% to the bank, you're then normally going to get a tax deduction of about 33%, meaning that it's really costing you 4% overall. If you've got an interest on a personal debt, especially your personal home, that's also going to be around 6% normally, but there is no tax deductions at all for that. So that cost is still 6%. So what we're looking at is really paying, say, 4% on your business or your rental debt versus paying 6% on your personal debt. So what we want to do is you always want to pay off the or try and eliminate or get rid of the highest interest. So the personal debt is your highest interest, so we want to look at ways to get rid of that. So one way is to see if we can rearrange it. With many property investors, you end up having a large current account in your company or trust. So this means over time you've introduced a property maybe into the company or trust, or that every year you've paid an amount into the company or trust and slowly topped that up. So what we can actually do is look at the company or the trust borrowing to repay that current account. That interest is tax deductible, and all it does is transfer more debt into the company or trust that you can then use to pay off your personal house loan. So basically we borrow in the business to repay these, which makes sense, and it's just making that interest tax deductible. If you're looking at something like a $100,000 loan at 6%, that's $6,000 interest a year. If you're saving at 33% tax, then that's saving around about $2,000 a year. It's quite a considerable saving for nothing just on $100,000. We can also look at restructuring this debt. So if you don't have a large current account in your company or trust, we can also look at restructuring. A common way is selling rental properties in your personal or partnership name and selling them into a company or a trust. What you need to be very careful with this is that the cost is less than the benefit. There's no point in it costing you $5,000 to do it and you're only getting $1,000 benefit from it. So you really need to weigh up the cost versus the benefit. If you are transferring properties from personal names to a company or a trust, be very careful with depreciation recovery. Legal fees, you've got legal fees to sell it as well as buy it, so there's sort of a double legal fee for that. And also, if you're looking at transferring to an LTC, a look-through company, be very careful of the loss limitation rules. So all of these ideas that you can put in place, you just need to be very careful with the execution and make sure you do it properly to get that tax benefit. Another common thing that we look at is, should you be paying principal and interest off your rental properties, or should you be paying interest only? It comes down to that same equation that we just talked about. Which one's the highest interest? So on your personal house, you've got interest with no tax deduction. On your rentals, you've got interest with a tax deduction. So if you've got a personal house debt, then you should only be paying interest on your rentals. So you put all your principal into your personal home, and then once you've paid off your personal home, then you can look at going principal and interest on your rental properties.